All right, let's jump straight into this explainer. We're looking at a completely fascinating case study today from Sunlands Technology Group's Q1 2026 earnings release, The Profitability Paradox. Now, if you've been keeping tabs on the adult online education space, you know it's wildly dynamic and frankly pretty challenging right now. But Sunlands, they present this incredible situation. Over the next few minutes, we're going to break down exactly how a company manages to wring significantly more profit out of a shrinking pie, relying entirely on the hard data and executive commentary from their latest quarterly report.
So right off the bat, there's this massive contradiction sitting right at the top of their earnings report. Net revenues for Q1 dropped to 440.7 million renminbi. That's a nearly 10% decrease compared to Q1 of 2025. Normally when you see a top line drop like that, you brace yourself for the bottom line to take a huge hit. But shockingly, their net income actually went up. It reached 76.8 million renminbi, which is a nice little bump from the 75.2 million they saw last year.
And here's the thing. This isn't just a one-off accounting trick. It's not a lucky break. They just hit a massive milestone. 20 consecutive profitable quarters. Just think about that for a second. That is literally 5 solid years of maintaining profitability through crazy market shifts, totally changing consumer demands, and real economic headwinds. It really proves that this bottom-line resilience, it's not a fluke. It is deeply embedded in their corporate DNA.
The absolute crucial point here is that even in a shrinking market, they aren't just treading water, right? They're actively widening their margins. Their net income margin actually expanded from 15.4% last year to a highly stable 17.4% today. This is exactly the kind of metric that business analysts obsess over. It tells us that for every single renminbi coming through the door, they are keeping a significantly larger piece of it as pure profit. But to figure out how they're pulling this off, we have to look at a metric that is flashing bright red.
Which brings us to the core mystery of this whole explainer. How exactly does a company lose tens of thousands of new enrollments and still expand its profit margins? Get this, new student enrollments literally plummeted from over 169,000 in Q1 2025 down to just over 102,000 this quarter. That's almost 67,000 fewer students walking through their virtual doors. It completely defies conventional growth logic, where you typically need this ever-growing base of students to drive profitability.
Section 1. Slashing expenses. The mechanics of the paradox.
Okay, so if revenue is dropping and enrollments are crashing, the only mathematical way to boost profit is by taking a super aggressive stance on your costs. But Sunlands didn't just swing an axe blindly. No, they orchestrated a staggering 19.5% reduction specifically in their sales and marketing expenses. In raw numbers, they brought those costs down from over 300 million renminbi to roughly 242 million. In the online education world, customer acquisition is notoriously expensive. Companies burn through millions just for clicks. By pulling back almost 20% of that ad spend, they immediately saved a massive chunk of capital, padding that net income directly.
Now, you might think, well, this was a panic move, a desperate attempt to save cash. But look at how management frames it. Finance Director Hung-Yu Lee explicitly points out that this was the continuation of a trajectory driven by deliberate choices made over several years, not short-term tactical adjustments. He noted this was the largest single-quarter reduction they've recorded recently. They purposefully chose to stop paying a premium for unprofitable growth. It's all about structural bottom-line health.
Section 2. AI and strategic shifts, doing more with less.
So how do you cut marketing that aggressively without completely starving the business? Well, CEO Tongbo Liu gives us the exact answer. He highlights a strategic pivot that relies heavily on tech and demographics. The absolute key phrases here are letting AI compound across the acquisition and delivery workflow and improving retention in our senior learning business. They aren't just shrinking, they are fundamentally rewiring how they get students and how they teach them, while pivoting to a very specific group of learners. If we translate that executive jargon into plain strategy, we get 3 main operational drivers. First, raising learner quality. They are done chasing every random internet click. They want committed students who will actually finish the courses. Second, letting AI compound across workflows. Using artificial intelligence for efficiency means they can do so much more with way less overhead. And third, leaning into the senior learning business. Older learners usually have clearer goals and way higher retention rates, so they are much more reliable and profitable to serve.
Section 3. The liquidity buffer. Building a fortress.
To really grasp their survival strategy, we have to look past the income statement and check out the foundation that's protecting them right now. Just look at this veritable war chest of highly liquid assets. It is remarkably stable. From December 2025 to March 2026, cash and equivalents dipped only slightly, going from 575.7 down to 545.7 million renminbi. Meanwhile, their short-term investments stayed rock solid at roughly 236 million. Despite a quarter where new enrollments plunged 40% and revenue shrank, their cash position barely flinched. Incredible.
From management, this cash isn't just numbers on a spreadsheet. It's literally a strategic shield. As they mentioned in the earnings release, this liquidity buffer gives them total flexibility to invest in tech and new business directions without feeling that intense near-term financial pressure. When you aren't waking up in a cold sweat over daily operating costs, you actually have the clarity to execute long-term transitions like fully integrating AI and pivoting to senior learners without hitting the panic button.
Section 4. The Q2 Horizon, Testing the Limits.
Okay, so the targeted strategies have worked beautifully so far to protect their profitability streak. But those market headwinds, they're about to blow even harder. Sunlands officially expects their net revenues in Q2 to drop even sharper than what we just looked at. While Q1 saw a 9.6% drop, they project Q2 revenues are going to plummet anywhere from 20.2% to nearly 24%. That drags net revenues way down to the 410 to 430 million renminbi range. This isn't a minor dip anymore. The shrinkage of their top line is rapidly accelerating.
Which leaves us with one final, incredibly sobering question to take away from this explainer. Where is the absolute limit of corporate cost-cutting when the top line just keeps shrinking? Look, Sunlands has proven they are absolute masters at defending their margins by slashing marketing and letting AI do the heavy lifting. But you can only cut expenses so far before you start hitting bone. If revenues truly drop by another 24% next quarter, can AI compounding and senior learner retention continue to pull off this profitability paradox? It is a high-stakes balancing act, and it's going to be absolutely fascinating to see how they navigate it in their next report.